Let's talk about the effect of Donald Trump tariff policies of 2025 and how it has impacted the US economy so far up until now in 2026. Because there's something a lot of people misunderstand about tariffs and inflation. Back then in 2025, when Donald Trump launched a global tariff war that hit the highest level in almost 2 centuries, everyone, including most economists, predicted similar economic outcomes, that imported goods would get more expensive and companies would raise prices on consumers and businesses, and inflation was going to skyrocket. But inflation actually did stay above the Fed target of 2%, but it was very tamed, especially in December when the US CPI showed prices rising 2.7% year over year, the slowest pace in 4 years since early 2021. Now there's a new research that shows why these results shouldn't have surprised anyone at all. This new research actually contradicts what most people think about tariffs. Most people often think that tariffs works only through prices, through import cost, and through companies raising the prices for shoppers and downstream businesses that relies on imports. That's actually true, but it's not the whole story. This new research tells us more about how US tariffs affect its economy. The new research is conducted by economists at the Federal Reserve Bank of San Francisco. They studied US tariff increases between 1886 down to 2017, and this is almost a decade worth of data. And what they found out is that tariff hikes usually don't lead to higher inflation. However, in many cases over this century worth of data, inflation has actually slowed down whenever the US increased tariffs on other countries. The data shows that on average, a 1 percentage point increase in tariffs usually don't line up with a 0.6 percentage point drop in inflation. Now I know that sounds really hard and surprising, but until you look at what tariffs does beyond just prices, then and only then are you really going to understand how tariffs really do impact the US economy. Now let's look at how tariffs affect the US economy beyond just prices. For businesses, tariffs do create uncertainty in making decisions on investment and business expansions. Also for consumers, tariffs do reduce their purchasing power because they face higher costs and fewer choices. So as a result of tariffs, businesses do cut back on expansion, and at the same time, households do reduce their spending on non-essential goods and services. That means overall spending and overall demand in the economy usually goes down due to surge in tariffs. So due to the drop in demand, this usually put downward pressure on prices across the US economy. Why? Because when companies cannot sell as much as they could with old prices, in order to attract buyers, they would lower prices or offer discounts, and this reduced spending slows the price growth across the economy and in turn tames inflation. Now that's making sense, right? Alright, let's move on. This same research at the Federal Reserve Bank of San Francisco that studied tariff impact from 1866 to 2017, their study also found out that higher tariffs often come alongside rising unemployment. So even though some imported items become more expensive due to unemployment, fewer people have the income growth that is strong enough to keep spending at the same pace of rising import costs. This particular data is backed by another study by economists at the Northwestern University, which also studied tariffs data for almost 2 centuries from 1840 to 2024. Their conclusion was very similar, that inflation usually ticks up after tariffs, but only slightly. Their study also concluded that higher import costs usually result in lower trade volumes, reduced manufacturing activities, and weaker demand from both consumers and businesses. Now bring this back to when Donald Trump announced sweeping tariffs lasting in 2025. Economists predicted 3 things. 1. Economists predicted higher inflation on household, and secondly, economists predicted a stronger dollar in the currency market. And the third prediction of economists was that there's going to be a sharp slowdown in job creation and investment. But what happened was not as predicted, neither was it entirely different, because inflation did rise above the Fed target of 2% after the tariff announcement in April 2025. But inflation did not skyrocket the way the public and the way economists had expected. But however, Hiring did slow down and unemployment edged higher, yet the overall economic activity continued and the economy did not fall into a sharp slowdown. At the same time, remember that the promised manufacturing boom in factory output, as was promised by the quote-unquote made in America promise by the Donald Trump administration, that has since failed to appear. So this clear gap between prediction and outcome have actually forced some economists to rethink their assumptions. One of the economists, known as Jonathan Ostray, a professor of economics at the University of Toronto, has summed it up by saying that just because tariffs hurt the US economy without triggering high inflation in the past, that doesn't guarantee the same outcome now and in the future. And the backup to that statement is because the last time the US import duties were as high was in the 1930s. But the difference between then and now is that back then the US operated under the gold standard and the US was an industrial power filled with a lot of factories. But today the US economy is service-driven, globalized, and structurally different. So because tariffs have not increased inflation, that doesn't mean that tariffs are harmless. Both studies by economists at the Northwestern University and the Federal Reserve Bank of San Francisco agree that tariffs do hurt economic growth, tariffs do reduce business investment, and tariffs do weaken consumer spending and also slow down hiring. And that slowdown is exactly why inflation pressure has remained limited. One more key detail that matters here is that the tariff rates that companies do pay is actually lower than the headline figures usually reported in the media. For instance, a case study from economists at Harvard University and University of Chicago found out that due to exemptions and loopholes, the real average tariff rate in September 2025 stood around 14% and not 27.4% as was reported in the news headlines. As such, that also reduces the inflation impact on final consumer prices. So to sum it all up, the real takeaway here is that tariffs don't just affect prices of goods and services, instead it change the behavior of businesses, workers, and consumers. And even though spending higher and investment slows down the economy, inflation pressure still eases. That's actually the trade-off of tariffs that most people miss, which is more controlled prices, but slow down in business and economic growth. Alright, that's it for today. We'll see you in the next one.